All right, so what is working to find great multifamily deals today? The market is changing. COVID has changed things. This post-COVID world has changed the market, has changed asset prices in general. So how do we find great deals? And with me, I've got a couple experts that I really respect on this topic. I've got Ryan Webster and Warren Dresner. Welcome, guys. How are you doing today?
Very good. How are you, Bronson?
I'm well. I'm well. It's really great to have you. I know we've been talking about doing this for a while, so it's excited to have you guys on the show today. But let's just jump right into it. So tell us a little bit about each of your story and just kind of how you got here. I know you guys both have. I always find it's cool with partnerships, kind of how people start working together. But maybe I don't know. One of you guys can start and just kind of talk to us a little bit about your background and kind of how you got started in real estate.
Yeah, absolutely. So I'm a real estate professional and entrepreneur, a National Home Builders Association award-winning home builder, and one of the founders and managing partners of Equity Yield Group here with Warren. And prior to multifamily acquisitions, I owned and operated a construction development company for a little over a decade here in the Midwest. So I started out on the other side of things, building new assets, stabilizing them and selling them, as opposed to acquiring stabilized assets.
I guess
Okay.
my background's a little bit different. So I spent 20 odd years in the corporate world with a background in finance and insurance. I got into real estate investing back in 2010, like a lot of people in single family homes. From there, I moved into multifamily as a passive investor. Really started with thinking about tax benefits, and then over time started thinking more about passive income. And then from there, got into an active role in multifamily around 2019.
Okay. Yeah, I know you guys have kind of different backgrounds and you approach real estate from a different perspective as well. Let's talk about that a little bit, kind of what you said, Warren, about kind of starting through passive investing. I know a lot of our investors, they are passive or they're interested in being passive, but they really want to become active. And you've been able to do that. You've been able to kind of cross over from being more passive and having, 2,000 units, both a mix of passive and active, and really start to become more active. Can you talk to us a little bit about the learning that happened kind of through that process and how you got started in passive investing?
There's always learning, I guess, everywhere along the way. I'd probably start with single family homes because most people, when they think about wanting to invest in real estate, that's where they naturally go. And what I found, which I think is consistent with a lot of people, is it's a lot of work and you got to deal with, the termites, toilets, tenants. So it's not for everybody. And I think that's a hurdle that a lot of investors don't overcome. They've got their busy day jobs. They think, I'm going to start investing in real estate. They buy a single family home or two, and then they can't manage. So they probably back away. Somehow, I think it must have been, I'm from Australia originally. I moved to the US about 3.5 years ago. I think soon after I got to the US, I discovered Bigger Pockets. And just reading on the forum, somehow I discovered this thing called multifamily. And that just opened a huge can of worms, or in a good way, and so I went into that rabbit hole, and there was a lot of learning there about the benefits of multifamily. As a passive investor, you can overcome a lot of those operational challenges that people struggle with single family homes.
I think that's a great point. I think a lot of people, me myself included, start with single family. We think, oh, if I'm going to do real estate, I've got to buy a house, or I've got to have a rental, or I've got to do a vacation rental or Airbnb. But once you have 1, 2, 3, 4, 5, 10, I think we got to 5. And I just realized how much work it was. Even if you're not the property manager, you're not the one doing it. There's kind of something called decision fatigue. You start having to make all these decisions. What do we do with the tenant that's not paying? What do we do with the toilet that needs to be repaired? What do we do with this issue, with that issue? And it was kind of surprising how much work it was. And I think that's a good question that people that are busy professionals is you have to think, how much is your time worth? And also, if you can't scale it and take it, twice as big or 10 times as big, then it's really not a passive investment. So there's a lot of things that are touted as passive investments, but they actually take a lot of time. And that's where passively investing in multifamily, like what you guys do and what we do, it's really a great solution. Ryan, I know you approach it from a very different angle because you're more an industry insider. You've been doing this for years. And can you tell us a little bit about your construction company? Is this specifically with multifamily, large multifamily? Is it kind of a variety of stuff? And kind of how'd you get going with that? And maybe talk a little bit about how that relates to what you're doing now.
Yeah, no, started the construction industry very young, and then started my own company. We did a lot of single family development, both developing communities and building new homes. Did some commercial remodels and commercial ground up construction. and then decided to switch over to multifamily, really in an effort to mitigate some of the execution risk that comes along with the new builds. There's not so much sensitivity to the real estate cycle on the stabilized side as there is with execution of development projects. And then you have cash flow day one as opposed to debt service and interest payments day one.
Yeah, it's amazing with some development projects, and I've kind of stayed away from them for that reason, that it can take sometimes even a couple years before you really are able to break ground or have a finished product. And so there's a lot more unknowns as far as where will the economy be, what will the credit cycle be, what will asset prices be, all that stuff. So you got to be able to be in more stabilized real estate is really important. Let's talk a little bit, just, either of you guys can jump in on this one, but you guys have both kind of addressed it a little bit. Let's talk about multifamily, kind of a value add approach, and just even, I know you guys are also doing Class A stuff that's, already built, but can you talk to us a little bit about the advantages that you see of doing multifamily deals and kind of what really drew you to do some of these larger deals?
Yeah, absolutely. We do like value add and the ability to force appreciation, and we do look for a light to moderate value add component even within our Class A assets. There's a broad spectrum of Class A. There's obviously the luxury Class A communities, and then there's just Class A that are newer vintage properties that still represent an affordable component to the luxury product in the market, but are newer properties. And one of the reasons we really chase the A and B class is, lack of headaches from deferred maintenance and a lot of the execution risk that comes with very heavy lift projects. And really with, change orders and, unforeseen things that you can't estimate, that aren't going to be in the scope of the work when you start out, but you find out along the way as you dig into things. But really the huge benefit to the AB is location driven and tenant demographic driven. The newer properties are in newer neighborhoods with better community amenities, and that tends to come with a better tenant demographic.
Yeah, absolutely. No, that makes a lot of sense. I know even with single family, sometimes you'd see, we were doing stuff in inner city Cleveland or kind of some suburbs of Cleveland, and, we were doing stuff in C or even, D plus areas. It just never works out the way you look at it. Right. And so some of these properties that are, some of the C or D class stuff, it's going to be really hard to get it to perform because of the tenant that's there, because of the older properties, whatever the issue is. And so you're getting a different type of tenant there. What about you, Warren? What are some things that maybe as a passive investor, when you started, what are some things that you like about doing large multifamily deals, or some of the, I call them unfair advantages that you see kind of available to investors that invest in multifamily?
So I think there are a number of areas. Economies of scale, it's you kind of mentioned it before, when you own 5 or 6 properties, you've got 5 or 6 mortgages. If you've got to get a plumber out to multiple properties, they've got to drive between the properties. If you're buying 100+ unit multifamily, you can have on-site maintenance staff there. Beyond that, though, you get more professional property management services, companies that specialize in managing these assets. You get better quality debt. Debt becomes cheaper the bigger the deal becomes. So debt is much more efficient for multifamily than it is for single family homes. And actually, I would suggest it's even better for A-class deals than it is for C-class deals, because the better the asset, the higher the face value of the debt, the cheaper the terms, often the better the terms on the debt. So there are a lot of economies of scale, a lot of benefits to multifamily, and then even more so on the AB class end of the scale.
Right. I actually want to talk about that because that's interesting. We do more B and C class, and I'm interested with the A class discussion because, it's really interesting with just what's happening right now in the economy, because we have, you talk to Ken McElroy, or you talk to, there's a third party group called, or a nonprofit called We Are Apartments. And basically, there's between 4.8 and 6 million apartment units. That's kind of where the shortage is right now as far as number of units needed. So you have these kind of inflationary and deflationary trends, right? You've got more money that's ever been printed in the history of the country. Basically 40% has been created in the last 2 years. So you've got these very inflationary things. You've got incredible demand. But interest rates being low, what happens, if they start raising rates up? or if we go into a recession, there's talk sometimes that Class A can be more sensitive to, if there are shocks in the economy or things happen, people move down to Class B. But then again, there's so many inflationary type of things going on. Can you guys talk about kind of how you see it in this season and how you see things going forward from the kind of the pro case for Class A that I think, maybe people would need to hear?
Yeah, again, and I think it kind of comes back to there's Class A and there's Class A plus. I definitely agree with you. In an economic contraction, I think there'll be a downflow from the luxury product to affordability, and so we don't really steer towards the luxury product. We look for Class A that represents affordability to that product. So we will catch those downflows, which are traditionally projected in the solid B class space, where you get upflow in good times and downflow in bad times. But in the lower tier of the A class properties, you experience the same thing. But your operating costs are a lot lower in the Class A. Your turn costs are a lot cheaper. Your maintenance is a lot cheaper. And in an environment here where we have interest rates coming up and everybody's wondering, well, what's the Fed's move? How hard are they going to pump the brakes? The cost of debt service definitely impacts cash flow. The cheaper your debt, the better things are going to cash flow. And there's definitely an interest among, the institutional debt funds and equity funds in this Class A product, where they don't need super high yields, but they are looking for quality product that's well located in strong markets to place their capital. And they tend to give quite agreeable terms to be in those deals.
I think on the affordability topic, the apartment complexes that we're buying, they probably have an average rent of $1,800, $1,900, which in the grand scheme of things is pretty affordable. I live in Miami. My neighborhood, it's probably $4,000 to rent a 2 or 3 bedroom unit. I know, Bronson, you're based in LA, and it's probably even more expensive than that.
Yeah.
So yeah, it's A class because it's by virtue of the fact that it's a new building, but these rents are still relatively affordable. So we don't think that if the economy takes a turn, these are the units that are going to be first hit. In fact, they might even benefit. They may even benefit from people moving out of the luxury A class into these A minus type units.
Yeah, it's really a good point you guys bring up, because I think, a lot of times I think of Class A as being super high end stuff. And we've got in Pasadena, California, where, we find we don't own anything in California. It's all in the Southeast for many reasons. But, people are getting at, $4,500 for a 2-bedroom apartment. And it is more of a luxury type of thing. But Class A is really, a lot of times they just do it as far as the age of the property. And you can't build Class B or Class C properties. Anything that you build, it is Class A just by definition, right? So I love what you said, Ryan, that there's different kind of phases of it. You have luxury, and then you just have something that's kind of new, but it's still more workforce housing. And if you're putting it in the right markets that are growing, it can do very well. So I appreciate you guys clarifying that, because that's something I didn't really think about. Let's kind of shift gears a little bit as far as, multifamily deals. You guys, Class A, Class B, can you guys maybe share some stories of just something you're proud of as far as you've done, as far as a different project that you're working on, or some things that have happened positively, or something like share about a deal that you guys have done?
So I guess we're proud of all of them. You're kind of asking us to pick which one of our babies is our favorite. I'd say the first property that we bought in Sarasota, Florida, is probably, we've both got a soft spot for it because it's just performed so strongly. Our approach to acquisitions is we start with the market, we look at the sub-market before we even look at the asset. And I think this one has performed amazingly well over the last 12 to 18 months. It's probably exceeding pro forma rents by $500 plus. NOI, I think, is 50% higher than what our year one pro forma was. So I think that one we're really proud of. That is exactly what we've been talking about. It's a 2016 build, so it's an A-class building. But despite it being only 5 years old, the kitchens looked like they were 25 years old. So there was a real opportunity to renovate the interiors, real genuine value add opportunity. And that one, yeah, it's been an amazing performer.
It's amazing that with a newer build that's only, like you said, 5, 6 years old or whatever, and you come in, and it's just amazing that not everybody builds the same way. And just because people build a project doesn't mean it's a great project. It doesn't mean that it's built for the right demographic. Or sometimes they'll build all 1 bedrooms when really the market needs 2 and 3 bedrooms, or they don't have certain amenities where you actually will come into a newer property and say, hey, if we put a pickleball court here, or we put a dog park or something. It's just amazing how that demographic, or maybe you're getting a certain type of demographic, but if you did a couple of things, it would open up to a whole new set of folks. So I think it's just amazing that trends change, things change, and even also people make mistakes, and this, as you know, and that's why this industry is very inefficient, and why deals are out there on multifamily deals. Let's kind of circle back to that topic we started with, of finding great deals. I know you guys are great at finding deals and locating and identifying. What are you seeing that's kind of working today, and how has it changed in the last year or two as far as finding deals and really getting those deals under contract? Don't both jump at the same time.
Just kind of due to the product type that we purchase and the markets that we purchase, our deals are fully marketed deals. We look for institutional quality properties that we typically buy from institutions. It's a very competitive space, especially, these institutions don't really do off-market deals. A lot of the equity committee won't allow them to forgo the marketing process entirely. But with that, buying quality product and quality areas gives us an opportunity to sell back to these institutions.
Yeah. I think something that I'm a really firm believer in is to go deep in a market rather than spread yourself too thinly. I think given that we own a number of properties in the same part of Florida, in and around the Tampa area, we really know the market. We really understand what's going on. We see on the ground exactly what rents are doing. So despite what a broker says in their OM or what CoStar puts in a report, we feel like we know the truth. And that depth of knowledge, I think, is a competitive advantage. So if we do see a marketed deal where CoStar got it wrong, or the broker might have got it wrong, that's the kind of deal that we can win because we've got that inside track.
Yeah, there's a couple of good points you guys made. One, just what you said, Warren, was just really about the, knowing your market. And I think a lot of times, we always say fall in love with the deal, don't fall in love with the deal, fall in love with the numbers. And if the numbers make sense, you've got yourself a deal. But if, like for us, our market, one of our markets is Atlanta, the other is Jacksonville, and we're on our third deal in Jacksonville, and we're coming up on 4 and 5 here soon. We've got them under contract, and it's like, when you know that area, like the deals will come to you, right? You'll basically get notified by something off market or a broker or something. And it's just amazing. And a lot of people don't understand this that aren't in the industry, how inefficient the system is, where a broker may not want to necessarily take it to market because they just want a sure thing. They want to know that it's going to close. They're legally not obligated to disclose even to their own client that they have multiple offers. They can just say, well, this one is a good offer and it's likely to close. And that was kind of amazing to me when I started to say, oh, wow, like this is really interesting how all this works. But you're right. It's just amazing how you're there, you buy something that, you're trying to kind of, if you're first starting out, it's like you're trying to get brokers to call you back. And then after a while, you just can't stop them from calling you because they got to always say, oh, we'll do this, we'll do that, we'll do whatever. But once you start owning stuff in town, you become a major player and people see you as being legit, especially if you have a good experience working with you, especially you don't retrade a deal or you're not doing stuff that is a little bit shady or underhanded. So I think that's a really good point. Yeah. What do you guys think right now about the current multifamily investing conditions? Obviously, like I mentioned, we talked about inflation, deflation. Do you guys see risks of rates rising? And if that happens, will that lower asset prices? What do you see kind of happening in the next 12 months or so as far as just in the multifamily space?
Yeah, absolutely. Multifamily is obviously a great asset class, a very, very popular one right now. There's a lot of capital looking to get into multifamily, which makes it a very competitive environment. And I do think, interest rates are going to cause some turbulence throughout probably the next couple of years. But again, our focus is really on, buying the best asset that we can find in, the strongest markets that we can invest in that present, strong fundamentals and evidence that the growth trend is going to continue. And when you talk about, real estate in general. It's always asset by asset, market by market. You can't take out the entire real estate market and bulk it into one trend. So looking in these strong growth areas, I think we are mitigating some of that risk of interest rates rising, and counteracting that with stable rent growth supported by higher and growing incomes.
Yeah. That's good. That's a good response. Yeah, and I agree too. Some people talk about real estate, as an asset class. And I'm like, well, which one is it? Multifamily, single family? What area? What size? What submarket? What build? When was it built? And so, yeah, and I think you kind of sounds like your premise is very similar to mine. Is if you buy in areas where there's population growth and you have job growth, there's business friendly, landlord friendly. You're going to continue to have good things happen because the rising tide will just raise all ships, regardless of what happens with interest rates and other things. You're just buying areas that are in demand. So I think that's really good. What advice would you give someone who's just starting out in multifamily?
You mean actively or passively?
I would say, either. Let's say somebody is, hey, I'm new to multifamily or I'm new to looking at this. Let's start. Why don't we have Warren? Why don't you take the passively one, and we'll have Ryan take the active one.
I'd say education. In this day and age, there are so many sources of information out there for free. Whether it's Bigger Pockets, I think is a great source. There are a number of books. There's YouTube. There are podcasts like this one. I think there's so much opportunity to learn, and so my advice would be just get as much intel as you can. Listen to as many podcasts as you can and get to know the industry and hear what people are saying about it. I think that would be my biggest advice.
Yeah, that's great. Ryan, what about you? What about actively? What would you advise someone who's getting started and wants to do syndication and do large deals?
Yeah, on the active side, you got to remember at the end of the day, it is a business, and investing in real estate in general takes persistence and grit. It's a very difficult industry to get into. But I think right now, if you're looking to be in the active side now more than ever, you got to know the numbers. You got to know the data that's supporting those numbers. Just because you pop some data into a spreadsheet doesn't mean that you have a business or a business plan that's going to make money.
Yeah, you're right. And it's some people make it sound like it's really easy. And I think that when I realized, hey, you really want to do this, I want to go full board into multifamily. It was kind of a whatever it takes kind of attitude. I want to go to as many conferences, meet as many people, look at as many deals, underwrite whatever I can, and just do whatever it takes, right? And so it's kind of that take the bull by the horns. But I feel like the skill set is so valuable when you learn how to do this, whether it's passively. For people passively, it's like to learn that, hey, I can invest generally in deals and hopefully double my money every 5 to 6 years. Obviously, we're not speaking about any specific investment, but those are kind of typical projections. That's a huge confidence builder to know, hey, I'm not only making good money in my job, but eventually maybe I could step away from it because I can develop this passive stream of income. And then also actively just starting to, network with investors and having those calls and looking at deals and underwriting them and all that stuff it's how you build it, just one step at a time. Let's talk for a minute about, one resource that's helped you in real estate. It could be a book, it could be an app, a website, a tool, or something that each of you can just share one thing that might help some of our listeners.
Yeah, it's a business and it's a team sport. One resource that's been great for us is having a great capital markets broker to go out there and source some different debt and equity options for us.
I think something that I kind of discovered in the last 6 to 12 months or so that's been really useful is a website called justicemaps.org. It's a great resource that can show you income at quite a refined level. So often when you're looking at a deal, the brokers might give you a radius of a mile, but that radius is just an average of what's on the west side and the east side and the north side and the south side. It's not always the best indicator of what the actual incomes are around that property. So we use Justice Maps a lot when we're vetting an area and a deal. So that's a cool little resource.
justicemaps.org. I'll take a look at that. That's great. Thank you. Thank you for sharing that. Awesome. Well, guys, I just wanted to really say I appreciate you coming on. It was kind of a brief time today, but just wanted to have people get a chance to meet you. And I have a lot of respect for each of you guys and the work that you do, and also in your partnership that you bring different elements into your deals. I think that's something that's really great, whether people are passive or especially if they're active, to find people that complement their own gifts. So if some people are good at work, raising money, then finding people that are more on the operations side. And, because of your kind of passive background and financial background, Warren, and then Ryan, your construction and more hands-on, and just really being able to kind of, see how things can become. I think that's really great how you guys work together. So I think that's awesome. How can people connect with you guys?
So the best way is probably to go to our website, equityyieldgroup.com. You can contact us there. You can sign up for our newsletter or our investor club. You can also download our free passive investing guide. So that'd be the best way. Awesome.
Well, gentlemen, I appreciate you coming on. I think this was great. And I hope people, I encourage everybody to go reach out to you guys and to get on your deal list about upcoming deals. And appreciate all the value you guys are adding to the industry and doing it in a very ethical way. So thanks so much for that. And look forward to staying connected here.
Thanks, Bronson.
Thanks, Bronson.
All right, so Ryan and Warren, it's really great how partnerships come together and you see each person's gifts really add to that partnership. And that's one of the things I didn't realize when I first started in multifamily, was that I thought I had to kind of do everything. I thought I had to be the guy who was finding the deals and who was, underwriting a bunch of stuff. And then I would, work with the investors and raise the money and operate the deal and asset manage myself. And I realized over time, the larger deal you do, the more people you need on your team, the less really you should be doing in that deal, and just be focusing on the one or two things that you do really well. And so, for me, I love, creating content, working with investors. I obviously approach things very much from a passive investor standpoint, where I am basically underwriting each deal, really vetting the property, vetting the deal operators, and my partners, as well as the particular market. And I think if you just buy in the right market with the right team, and the deal looks good, you're going to do well over time. And really, I think one thing that came out to me was in this interview was just the idea of when you buy in the right market, and especially an area where you're seeing so much migration, population growth. We're seeing it because of COVID. We're seeing it because of people retiring, and areas such as Jacksonville, Florida. They mentioned Tampa, Florida, Atlanta, other areas that we're just seeing such substantial population growth. We're seeing businesses move there. And really my philosophy or my thesis is that even during times of recession or times where things are not good, we're still going to see, maybe even more people move to these areas because of business friendly things. We're seeing, Elon has left, Disney, all of these things. Even recently, Newsom's trying to, hey, come back to California. Well, you made it too hard in California to have a business or to do businesses. So a lot of businesses in the Northeast or the Midwest are moving to Florida. They're moving to Texas. They're moving to these areas. And also retirees like warmer weather. They also can buy a house in a decent area in a place like Jacksonville for $300K or so, which is awesome, right? So anyway, I hope you got some value out of this interview. It really, as you're learning, it's important that you pay attention and really listen to more interviews from different types of people that are doing different types of things, and also you see their backgrounds and kind of what they bring to the table. So if you are interested in being active, I just encourage you to take action. Really go to conferences, look at deals, network with brokers, do everything you can to try to just be more in motion. And the same thing is if you're passive, it's not that you do nothing. It's just that your actions might look a little different. So, what it could mean is you get on people's deal lists. We have our deal list at bronsonequity.com. You can go to the website and click on our join button. We'll set up a call with you and be able to share future deals with you. You can go to other operators, go to Ryan and Warren's site, go to other people's site and be able to connect with them. And you can basically get on other people's lists. And then you'll start to know, after you've seen 10 or 20 deals, you'll start to see, I think I know what I'm looking for. I think I know what a good deal is looking at. I think I know what being conservative in a deal really looks like. So anyway, I hope you enjoyed this, and we'll look forward to seeing you on the next episode.
You've been listening to the Mailbox Money Podcast. For more free resources, articles, and videos, go to bronsonequity.com. There you can download your copy of the special report, The Single Best Investment Strategy During and After a Pandemic. None of the information shared here is an offer to buy a specific investment, and this is for educational purposes only. Consult your financial, legal, and tax professionals and use your own common sense before making any investment decisions. Thanks for joining us, and be sure to tune in next time for more Mailbox Money.